walk over me. Here you go again, always me. All the things you say, none of it comes true. Met with a guy in LA. Good for you, it's all about you.
Life is an illusion. Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air?
It's rock and roll. It's rock and roll. It's rock and roll.
And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. I'm your host, Lance Roberts, of course, as we get into another week here in August, heading into, of course, September, October. Those are the weaker months of the year. So, again, markets have been on a very strong run here over the last 3-4 weeks. And, got to go back here a little bit and talk about, history a bit. And you'll remember that back in really kind of this, kind of late April, early May, markets were under a lot of pressure. And we were talking about how everybody was bearish, right? There were so many people that were bearish. The end of the world was coming and, we were in a massive bear market and this is just going to be terrible. And I said then that, when everybody is that bearish, everybody's on one side of the boat, that tends to be a contrarian signal for markets. And generally, you're going to get a fairly strong reflexive rally. And that's exactly what's been happening here over the last couple of weeks. Now, lots of articles out trying to, it's a new bull market. Maybe it is. Maybe the bottom is in. Right? We won't know that for a while yet, but there are a lot of technical indicators that suggest that maybe we have actually put the bottom into the markets. And we'll talk about a few of those things this morning as we talk about this battle royale between the bulls and the bears. It's very interesting because, just a month or so ago, everybody's super bearish. Now we've got this bull-bear debate going on and the media getting extremely bullish. One of the things that we had said previously is what we needed in order to have, this kind of counter trend rally, to go well, we needed people like Jim Cramer to get on TV and say the bottom's in. Well, he's done that now, right? He's claimed the bottom's in. This is your window to buy stocks. Maybe he's right. It's interesting because, we've talked about the Federal Reserve so many times here, in their hiking rates, obviously, and tightening monetary policy to help quell inflation. And the hope now is because of this rally in the markets that the Fed is now very close to ending their rate hikes because we had a softer print of economic inflation data last week. And so, and again, lots of misinterpretations about that data. For instance, even the president coming out said we had zero inflation, right? It's good news, zero inflation. No, we didn't have zero inflation, right? Inflation actually still went up last month, right? There was still higher prices last month, but because we are comparing it to where we were last year in terms of the rate of increase, if we were up 0.2% a year ago and we're up 0.2% now, that rate of increase is zero, right? Because we're comparing on a year-over-year rate of change. So just because inflation didn't change from a year ago's print didn't mean that inflation didn't go up last month, right? Prices still rose across the board. But the reason that we didn't have this inflation push, so to speak, and we saw a softer print in inflation, was because energy prices came down enough to offset the increases in food prices. But importantly, the average person spends a lot more on food than they do on gas every month. So when you talk about the impact to the family budget, there was still inflation, right? There was still impacts on households because food costs went up. Energy prices went down enough to offset that. But again, doesn't mean that's on a dollar for dollar basis, right? So we don't buy the same amounts of goods and services, but that's what kind of went on. So inflation was still there. Now the thought here is that the Fed will now back off of hiking rates. They're going to hike rates in September when they have their next meeting, and of course their confab in Jackson Hole comes up at the end of the month. So we're getting a lot of information from the Fed about exactly what they're thinking about in terms of inflation. But the expectations from the market right now, anyway, are that the Fed will stop hiking rates. They're going to hike one more time, they'll be done. Now, that's interesting, and the Fed's even made some comments about this. They said, hey, we're close to the neutral rate, right? That's where the interest rates are at a level to where they're tracking economic growth. Well, interest rates are at 2.25% right now. Say they raise 0.5% in August or September, that's 2.75. So what they're saying is that economic growth is going to be about 2.75%. That's not real strong, right? And we've still got to come down. That's nominal rate of growth. So that's got to come down some more. But again, the idea here is the Fed is now finished, and this now puts the bulls back in charge. Well, there is one caveat to all of this, and again, when we talk about this battle royale between the two camps, the question is whether or not the Fed is going to start lowering rates. See, this is the big question, right? Where the Federal Reserve really benefits and provides the wealth effect to the stock market is when they're cutting interest rates and they are increasing their balance sheet. Right now, there's no indication they're going to do that. The Fed may stop hiking rates at some point. Absolutely don't know where. But they are going to stop hiking rates at some level. But there's no indication here at this point that they're going to come back and start reducing those rates back to zero and doing QE. Right now, they've got a $9 trillion balance sheet they're trying to reduce. They're doing that at $95 billion a month. That's going to start putting some liquidity pressures on the market. So again, markets have had a fantastic run here. And again, I certainly suggest using this. If you didn't like this sell-off that we had at the beginning of this year, great time to be, kind of rebalancing risk in your portfolios. Now look, the bullish bias is in. We're going to talk some more about that this morning. There is a bullish trend in the markets, and there are certainly some very bullish indicators that are going on right now. The 20 days crossed above the 50. It's very close to crossing above the 100. The markets are very close to testing the 200-day moving average. If markets can break above the 200-day moving average, well, that's going to put all-time highs in sight, and that's going to be hard for a lot of people to fathom. It's like, how can we we're in a bear market. How can we be getting to all-time highs in markets? Markets can do things that they don't make a lot of sense. Right now, stock buybacks are running at a record pace. And remember, we've talked about the importance of stock buybacks previously. Those corporate share repurchases have provided almost 100% of the net buying for stocks over the last couple of years and have adjusted for 40% of the entire increase in the stock market since 2011. So buybacks are very important to the overall market movement. Right now, we've got a record level of announced buybacks that are in process. So that's helping also provide this lift as corporations are buying back their shares to reduce the number of shares outstanding. So when they report weaker earnings, they don't look as bad, right? So it helps keep their stock prices elevated. Markets are overbought on many different levels. And again, whether it's the MACD or a variety of these other technical indicators that represent kind of overbought, oversold, buyers are all in right now. We've got everybody in the buy camp, very few sellers left at this point. So again, when you try to push this market higher from here, it's going to get a bit more challenging because you're simply just kind of running out of fuel for the markets, and you're going to need a pullback here at some point to kind of reset that. Now, those pullbacks are going to be very important. If we get a pullback to the 100-day moving average or the 20-day moving average, which is now above the 50, there's lots of support points now right below where the market is. So even if the market fails here initially at the 200-day moving average, there's lots of support points here on a pullback that'll provide much better opportunities for you to add equity exposure to your portfolio versus where we are right now. Again, market's very overbought. Get a pullback here that works off some of that overbought condition. Much better place to start putting capital to work. So be a little patient here. You're going to get a correction at some point, whether it's the next week or two. It doesn't really matter. You are going to get some type of pullback here. Again, very strong rally here over the last couple of weeks. And again, just those very overbought levels are going to provide a better opportunity. So just be patient here. Preserve your capital for right now. Kind of pick your spots and you'll be a little bit better off. But also, don't dismiss the downside risk. That certainly has not gone away entirely. We got a lot to get into this morning here on The Real Investment Show. I'm your host, Lance Roberts. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So the Bull-Bear Royale battle, that's what we've got going on right now. And of course, it's interesting because, as we said earlier, just a month or so ago, we're on the show talking about how everybody was bearish. There was nobody that was bullish. And now it seems like very quickly everybody's back to the bullish camp. Right? And look, being bullish is a lot more fun than being bearish. No doubt about it. It's also a lot easier, right? Markets are going up, just be invested. That's a lot easier job than trying to navigate a bear market. So me, for one, I'm all for bull markets. It makes life so much easier to navigate, allocating portfolios and managing risk. So, it is, but, the question really is the bull market back, or are we in the middle of a kind of just a reflexive rally within a longer term bear market? And there's certainly arguments to be made on both sides. And this is what we did in this past weekend's newsletter. If you go to the website, realinvestmentadvice.com, and click on the Bull Bear Report, we went through the bull and the bear argument, right? So we kind of laid out the bullish case. And look, there's a very good set of bullish arguments. But from a bullish standpoint, the markets have now retraced 50% of their decline, right? So if you look at the top of the market in January and the bottom of the market, we've recovered 50% of that. Now, that's called a Fibonacci retracement. Don't worry about that part. Here's the important part about it. There has never been a point, you have to go back to the 1930s to find a point to where the market rallied recovered 50% of their retracement and then went lower. Every other time since like the 30s, every time you've had a Fibonacci retracement of 50% from peak to trough, you've gone on back into a bull market, right? And it doesn't mean just went straight up, right? I mean, you had, bounces on the way back up. But typically, when you get there and you've done this, that's typically been a fairly bullish sign for the markets. Also, too, you've got, the 20-day crossing above the 50-day. You've got the weekly buy signals now starting to come on the shorter-term weekly buy signals back into play. And typically, once you get the weeklies, kind of the short-term weeklies, then, of course, you also get the longer-term weeklies to follow. That's also kind of confirming that you're back in a bull market. There's some monthly signals also suggesting that, well, we've never actually been in a bear market. And this is hard for people to imagine after everything that you heard on television about how, it's a bear market and it's the world's coming to an end. It's all over with. We never broke the 3-year moving average. Bounced right off of it last month and this month and have rallied sharply off of that. And again, there's several signals we cover in the newsletter, which is on the website at realinvestmentadvice.com, that, support this idea of this continuation of a bull market, right? We've never actually been in a bear market. We were in a correction, and now that correction is over. Now, that's hard when you think about everything else that's going on, right? You've got weak economic growth, you've got inflation, you've got all this other stuff that's going on. And, you're just trying to figure out, it's like, well, this doesn't make any sense. How can markets be, running up when all this other bad stuff is going on in the economy? And there's certainly, an argument to be made for that. And, you never want to say that this time is different because that's, those are the 4 most dangerous words in the market. But this time is different. Every time is different, right? It doesn't matter whether it's, inflation or whatever it is, every market, every environment is different. The economy is different than it was last time. Inflation is different than it was last time. But there is, the issues that are weighing on the economy, right? We've got inflation at the highest level in 40 years. The Federal Reserve says that they're committed to fighting inflation, which would suggest they're not close to stopping the rate hikes. They're certainly not close to starting to ramp up their balance sheet. There is no financial instability, so there's nothing to force the Fed back into the markets. Earnings are going to have to come down because economic growth is slowing. Whether or not we get into a recession is a debatable issue, but there's a lot of indicators that certainly suggest a recession is coming in 23. Stocks don't tend to perform well during recessions. But back on the bullish side, stocks tend to lead economic data. And if the market rally here is a turn from bearish back to bullish, our market's already kind of sniffing out that the worst has been priced in terms of earnings declines and profit margins and those type of things. I don't know. I would suspect that with inflation remaining high, and look, inflation's going to come down. We've talked about that before, that we've already seen peak inflation. We've priced that in. And that's a lot of what the market's doing right now. It's pricing in that peak inflation. But as inflation begins to decline, it's going to decline, but it'll decline slowly. So even by the end of this year, we're still going to be dealing with 6%, percentage or better inflation. That's not cheap, right? It's down, but that is still going to be weighing on profit margins of corporations. Earnings have already come down a lot, but it seems to me they're going to have to come down more to get there. So again, it's this real difficult area to be setting in with, your kind of your investment allocation. Do you follow the market right now? A lot of people are jumping right back into and not surprising, right? Psychologically, we do this. We have hindsight bias. So we tend to look at what happened previously, and then we go jump into those very same stocks. And we're seeing that, right? A lot of people jumping right into the meme stocks and a lot of the high-risk stocks that have been beaten down 60, 70, 80%, whatever, buying those stocks again, even though fundamentals don't support them. They're jumping into those. So now the question is that where we want to be? And this is, like I said, this is the challenge, right? So we've got to kind of navigate this, one side of the argument, which is bullish, but then we've got very good bearish arguments. And those bearish arguments certainly hold water to a large degree that, there could be another downside leg to this market, ahead of us. But again, prediction, and this is, I talked about this with Adam over the weekend, which our latest, market weekly wrap is on the website, realinvestmentadvice.com, right there on the homepage. But I was visiting with Adam Taggart on Friday talking about this very same thing, is that, there is this pull to both sides of the markets. And, the problem is that if you take a bet on one side or the other, it's like, I don't believe this bull market rally, I'm going to short the market. You may be right. You could also be very wrong. Consequently, if you say that the bull market's back, right, I'm going to listen to the media, bull market's back, I'm going all in, you could be wrong. And that's the problem. It's about an equal coin toss right now between the two arguments. Short-term market is definitely bullish. If you're trading this market, you need to be long the market, because right now, very short-term, over the next few days, few weeks, this market has a definite bullish bias to it. Once you get past that point, it gets a lot trickier. And again, we've talked about before that predicting the financial markets is one of the most difficult things to do, because, again, there's so many things that happen and so many things that change. Economic data changes, it gets weaker, it gets stronger. Reports are all over the place. Things happen. Just like overnight, China cut their interest rates over weaker economic data. Nobody was expecting that to kind of come. So it got this surprise rate cut from China. So that's, again, weighing on energy stocks this morning, because, again, if China's got weaker economic growth, that means less energy consumption, more surplus in oil, so a la weaker energy prices. So everything has these dueling effects. If you're long commodities, well, that's not good for you. If you're long, other areas, it can be good for you. But these are the battles, right? And this is why it's so difficult to try to navigate markets. And look, I don't blame people that are just, buying ETFs and just going, I can't do it. I'm just going to buy an ETF and let the market just do its thing, and hopefully it'll just wind up higher at some point. And that's a pretty good bet. Long term, if you have enough time, it's a pretty good bet if you just buy some ETFs, hold them and you're good. You just need enough time frame to let that happen. Now, again, you'll get average performance, and again, you're going to go up and down with the markets, and things will work out as they work out. And when you're talking about valuation, still, even after this decline this year, we still have 30 times earnings. And as earnings come down more, those valuations are going to go up. So you're still running at historically very, very high levels of valuations, which, typically suggests you're going to have lower forward rates of return. And if the Fed isn't coming back to do QE anytime soon, even if the market rallies, if the Fed doesn't do QE, if they don't cut rates back to zero, forward returns are going to be lower. Because, again, as we talked about on Friday, and again, we have a really important article on our website from Friday talking about returns going forward and how over the last 12 years, the interventions by the Federal Reserve and the government have lifted returns for markets by 4 percentage points above the long-term average. Long-term average is 8%. Over the last 12 years, we've done 12% on average, and that's historically abnormal because that's much faster than the rate of growth of the economy, and that's not sustainable. So without those artificial influences, if the Fed is done hiking rates, okay, great, but they're not cutting, and they're not doing QE. that liquidity drain is still going to impact markets. The markets still may be bullish, but you're going to have lower rates of growth going forward. See, lots of things, it's a very difficult thing. I wish I had the answers. I wish I could just tell you what it is. We're trying to figure all this out together. That's why we publish so much stuff on our website, realinvestmentadvice.com. You need to check it out. Latest articles, newsletter, video, everything we just talked about. It's all at the website right there on the homepage, realinvestmentadvice.com. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Let's be honest. Me and Brent, we're here whether it's sickness or injury.
Without fail.
Without fail. Danny gets a little sniffle and he's at home all curled up with his blankie.
Well, he's got all those Petri dishes on legs running around his house.
You know what, though? But I had that.
Yeah?
You know what happens? Your immune system gets a lot stronger.
The Real Investment Show podcast. Same show, your schedule.
Drink out of the garden hose.
At realinvestmentadvice.com.
That was the best water.
It was. It's not great for you, but...
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Unintended consequences. Funny things happen when government tries to do stuff to help people. And, just recently the Inflation Reduction Act was passed, so $700 billion boondoggle that'll supposedly is going to solve our climate change problem by getting more people to, buy electric vehicles and install solar panels and all those type of things. And the bill is chock full of, payouts and giveaways and all kinds of stuff. And that was all what they had to do, of course, to, get this passed. One part of it is the 87,000 IRS agents that would like you to come to work for them. And if you've got an interest, the IRS is hiring. And one of the, kind of the benefits, you get to carry a gun and knock down doors. So, this is, it's funny. We fought an entire war to get away from tax collectors, and here we go again. But inside of this bill are a lot of tax credits to individuals to buy, electric vehicles and to buy solar panels and do these things. And of course, now this is spread out over 10 years, so none of this is coming anytime soon. And as is always the case with these government bills, the promises often fall well short. And again, just as soon as, power changes in Washington, a lot of this will likely be repealed also. So, the IRS will get defunded and a lot of these tax credits will get reversed or, whatever, right? So it just depends on who's in power. And these bills are great. And, but the odds of it actually reaching maturity are a very different story. But nonetheless, unintended consequences are always the sideline of this. And again, this is the one thing that government never thinks about. For instance, when we were sending out checks to households, right? This sounded like a great idea. Let's send people money so that since the economy shut down, they've got money to spend. Well, that's great. But there's nobody producing anything. And so everybody's going to run out and buy stuff to fix up their house or whatever because they can't go anywhere. And voila, you get inflation, which is now crushing individuals. So you didn't really help them much. One of the things that people were upset about was that we didn't, in the latest bill, particularly this latest spending bill, the Inflation Reduction Act, people were upset. People like Bernie Sanders and others are very upset because they stripped out student loan forgiveness and child care and paid leave and all those type of things that the administration had promised the average voter. They didn't get anything. This bill's got nothing for the average person in it, except probably being audited a lot more. That's about all you're going to get out of it. But, the important thing is that, for instance, you take something like child tax credits, right? So, or paid, paid medical leave or any type of thing, right? We're gonna, give you more money for child care. Well, that's great. So I give you more money. I give you an extra $2,000 a month for child care. And as we've talked about before, immediately all the child care providers raise their prices because, hey, you've got more money to spend. So you're going to spend it on me for child care. So I'm going to charge you more. It's basic economics. That doesn't change. But this is the thing that always eludes our, the people and, that are passing these bills. They don't say, well, if we do this, all we're going to get out of this is X, right? Prices are going to go up. They don't look at it that way. They're just like, oh, we just got to do this. We got to give people money so we can get their vote. What happens to them after that? Their problem, not mine. But it just makes things worse. And I thought it was interesting because over the weekend, the CEO of Ford was having a presentation talking about their electric vehicles and things like that. Kind of gave the middle finger to Elon Musk in the middle of towards the end of the presentation, because again, this is, everybody's kind of watched Elon Musk and his bravado now. So everybody's going to play that kind of same game on the EV side. And importantly, with electric vehicles, only rich people can afford them anyway. These are, these cars are 60, 70, 80, 90, 100,000 plus, right? So it's, your average American isn't buying an EV. It's people with means. But one thing that the CEO of Ford said that was very interesting is that, this Inflation Reduction Act provided or extended the $7,500 tax credit if you buy an EV. Awesome. So if you go out and buy an EV, you get a $7,500 tax break. I told you that I had priced out solar panels before on my house, and I had run all the math back then, and they came up and said, oh, well, if you install solar panels in your house before I moved, if you install solar panels on your house, then you're going to save all this money on electricity, plus you get these tax credits. So I ran the math. I mean, it's not hard to do. You run the math, it was going to take me like 32 years, something like that, to break even on the savings. And that's assuming that I get a steady flow of, electricity coming from solar during that time frame. So, no cloudy days, no freezes, nothing like that, right? So anything like that happens along the way, that extends that payback time. But anyway, that's that story. So this Inflation Reduction Act added, or extended, I should say, the $7,500 tax credit for EVs. And I thought this was great. This is awesome, right? Now people can go out and they buy EVs, and they get a $7,500 tax credit. So instead of it being $70,000, it's only $63,000, right? So still not affordable for a lot of people, but hey, you still get $7,500. Well, so if I know, right? So if Brent is making EVs and he knows that I'm getting a $7,500 tax break, what do you think he's going to do with the price of EVs? As he sardonically smirks and rubs his hands together. What do you think Ford just did? Ford just announced that they're hiking the prices on their Ford EVs by $8,500. $8,500. Not $75,000, $85,000. So great. Before the Inflation Reduction Act, you could buy a Ford electric vehicle for $8,500 less than you can buy it now. And yeah, you weren't going to get the $7,500 tax credit, but hey, you were still going to be able to buy the car for $7,500 less. It's now going to cost you $1,000 more, even with the tax credit. Unintended consequences. It's just, and this is the whole problem with, a lot of this stuff is that, what government does, it sounds great on the surface. And look, this is all very timely. All this stuff that's going, if you haven't noticed the ramp up in just stuff over the last couple of weeks in particular from, economic data suddenly turning a lot more positive. Of course, it's published by government agencies. To, passages of bills, to, a whole variety of other things. It's election season, right? Midterm elections right around the corner. And we've seen this before. And again, when I talk about, economic news being, better than expected, we saw this before, right? When Obama was running for office, we saw economic data tick up just prior to the elections. And after the elections, it all got revised back downward again. So this wouldn't be the first time, right? I mean, it's just our mistake. We just kind of overstated that number. Our mathematical adjustments were slightly off. That's not conspiracy theory or anything like that. It's just the way things work, right? It's just, it is what it is. And you just have to know that that's what goes on, and it's okay. There's nothing wrong with it. But again, this is why you also need to take stuff with a little bit of grain of salt and say, okay, I realize that employment data is exceptionally strong right now, but there's a massive gap between the reported employment numbers currently that are coming out and the household survey, which is fairly unprecedented. In other words, what the government is reporting is vastly superior to what the household survey is saying is going on employment-wise. And again, if you kind of just pay attention to headlines, we're seeing a lot of companies laying off workers. Amazon, others, right? We're seeing a lot of layoffs that are going on. Layoffs are taking up, jobless claims are taking up, but employment still cranking out quite strong numbers, even though the household data that's underneath it. Now, again, this is what's important. The household survey is the survey. That's the phone calls to houses where they call up Brent and say, Brent, you working? Brent says, yeah, I'm working. He's like, well, are you working a full-time job? No, I'm working 3 part-time jobs. Okay. He's employed, but he's working 3 part-time jobs. So multiple job holders have been a big chunk of this employment report as of late. But the household survey, the actual phone calls to the houses that they take. So on the first Tuesday of every month, they call 60,000 houses, and they call the same 60,000 houses for like 3 or 4 quarters. And then they rotate to new houses. So they keep kind of surveying the same house for a couple of quarters to see what the changes are. And then from that survey, they then extract and then they begin to apply their mathematical adjustments, the birth-death adjustment, the seasonal adjustments to the data, et cetera. So they take that raw household survey data and then they begin to adjust it with all their mathematical adjustments to get the employment number. And that's what you see. There should be a correlation between the actual official number and that household survey. But currently there's not. Telling two very different stories. I'm pretty confident that after the election, we'll see those numbers come back together pretty quick. We'll just see which one gets revised up or down. All right, be right back after the break. Wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Getting ready to kind of wrap things up. Futures are pointing lower this morning, just a bit. 10-year yield at 2.82% this morning. Futures are down about 22 points on the S&P, about 170 points or so on the Dow. Again, not terrible. Again, we had talked about in this weekend's newsletter on the website, realinvestmentadvice.com. Click on the Bull Bear Report or just click on the newsletter link at the top. You'll get it. It'd be likely, and it wouldn't be surprising if we saw a little bit of profit taking this week. It's been a very strong rally here. So again, a pullback to the 100-day moving average would be kind of your first, kind of area to start looking at, maybe adding some exposure. The 20-day just below that, and then the 50-day. So as long as those support levels hold, those will be good areas to kind of look to, picking up some stocks that have had, have formed bottoms. And are looking much stronger momentum-wise. And if you're looking to add some things to your portfolio, you'll have some opportunities to do that. So again, just, that's kind of the technical short time frame that we've got going on right now. But as I said earlier in the show, there's certainly, caveats, why we're not done with the bear market yet either. And there's certainly plenty of arguments for that. But again, those are longer term arguments that may or may not come to fruition. And so those are the challenging things. And that's what makes it hard to navigate markets. The rally over the last month has been, phenomenally good and not unexpected. But the question is now is the bear market bottom in? Have we seen the lows for this, pullback? Or is this rally just a kind of a stop along the way to potentially lower levels? And there's certainly very good arguments for both sides. And I can argue both cases with you, very quick, very, eloquently, right? I can make a very bearish case for you. Also make a very bullish one too. This is the problem. Both sides have very valid arguments, and only time will tell which one's right. So again, when we take a look at valuations, for me, one of the biggest challenges going forward is valuations. Whether you look at the Buffett indicator, which is market cap to GDP, or you take a look at just valuations in terms of earnings versus price, either on a forward or trailing basis. Yes, those have corrected somewhat. We have cheaper valuations than we had at the peak of the markets, but they are by nowhere cheap, historically speaking. So it still seems that we still have some work to do if this is a bear market, if we are going through a valuation reversion. And there's certainly some decent arguments for that because earnings need to come down some more. Earnings estimates are way too high with 8.5% inflation. Just you can't keep earnings at that level. When you're running 8.5% inflation and you can't pass all that inflation on to consumers, your margins are going to compress. Earnings are going to come down as consumers spend less. So earnings estimates are just too high. Now they've come down. The question is if they've come down enough. And a lot of that will actually depend on whether or not the U.S. slips into a recession or not. That's the big story. Look, the first 2 quarters, negative growth, not recession. Recessions, if we're going to have a recession, likely in 23. Second quarter 2023. We'll see. Again, the problem with economic data is that we've got to wait for all the revisions to come in. Right. And so, for instance, the second quarter GDP likely to be revised up. Then we have 1 quarter of negative growth. And then, of course, then you get some months, some quarters that we think are positive. Those get revised negatively. And then we look back and go, oh, yeah, there was the recession. It wasn't the first 2 quarters of 2022. It was in the fourth quarter and first quarter of 23. But that's the problem, is that we don't know until all of that data gets revised. And that's going to take a while. And that's why all this is so difficult and challenging. One of the, kind of the things that we want to continue to pay attention to, again, is just really is earnings. And again, we just went through the majority of the quarter 2 earnings. Still got a few companies out there that need to report, but we've gotten through about 80% of the companies. And earnings were okay because they weren't as bad as expected. And that's really the big story. We can't have a running bull market on earnings being not as bad as expected. So next quarter, earnings have got to be better. Earnings have to be better than expected. And that's possible because as earnings estimates are being dropped, now this gives the ability for companies to actually beat those earnings estimates, right? And that's why I always make these jokes about we're going to play the beat the estimate game every quarter because Wall Street, we call it millennial soccer because everybody gets a trophy. We keep lowering the standards by which companies have to meet in order to beat their estimates. And so we keep lowering earnings and the companies get over the hurdle by a penny and we go, ooh, they beat estimates, right? Well, you keep lowering the number enough, everybody's going to get over them. And that's why we keep having 80% beat rates. If Wall Street estimates and analysts were held, you get one shot. Brent's a Wall Street analyst, right? At the first day of the first quarter, Brent says, I think Apple's going to earn $2.63 for the quarter. Okay, Brent, that's your number? That's my number. Okay, you're stuck with it. Now let's see how good Brent is at the end of the quarter, right? But that's not what happens. Brent says 263, then it's 260, then it's 255, then it's 250, then it's 210, then it's $1.55, and then it's $1.25. And then Apple reports earnings, it's $1.26. And everybody goes, well, Brent's a genius. He nailed it. And that's how we treat these analysts, right? It's a moving target. And it's really invaluable. It has no value. These earnings estimates have no value at all. If you really understand what goes on with earnings estimates, this is about Brent keeping Apple as a client of the Wall Street firm, as an investment banker client, because that's where they make their money. People don't care about retail. Wall Street does not care about retail investors. You're cannon fodder for them. They're the ones that are dumping product on you, right? If you don't believe me, go look at the SPACs and IPOs that were done in 2020, 2021, how those have turned out. Ironically, right now, nobody's doing IPOs because nobody wants them, right? But the analyst's job is to make sure the companies stay happy and they keep their business with that firm. So, that's why you never see a sell rating on a stock, right? You never see an analyst go, oh yeah, we've got a strong sell on Apple. It's not good for Apple stock price. And since that's the way corporate executives are compensated, if Brent puts a strong sell on Apple, then Apple moves their business from Morgan Stanley over to Goldman Sachs, because that analyst will give them a strong buy rating, and that helps move that stock price up. Now, that's not conspiracy theory, by the way. That's just business. But if you don't understand it and you're actually looking at these earnings estimates going, wow, they're beating estimates, you have to pay attention to where they came from. Were those estimates being adjusted up, or were they being adjusted down? That's really what you need to know. One thing to keep paying attention to, and again, as we talk about all of this, and again, the market is very bullish right now, and you need to be paying attention to that, because there's a lot of indicators that are supporting the more bullish narrative of the market. And so from a trading and investing perspective, you're better off to be long the market than short for the moment. Now, it doesn't mean that won't change, but right now, the trend is positive. And we've been kind of warning you about this for a couple of months, that this would happen. So here we are, but at the same time that this is going on, pay attention to what's going on economically, because that is going to show up in earnings, right? We're seeing a lot of companies laying off people, cutting back on hiring, freezing hiring. The scope of the layoffs right now isn't real clear. We're seeing them start. We're hearing people like a lot of tech companies talking about laying off people, Snapchat and others. Talking about, companies like Walmart, Target, Amazon, laying off workers, freezing hiring, those type of things. That's all that preliminary stage heading into an economic slowdown. Now, layoffs turn into terminations, right? Because what's a layoff, right? Brent, I'm going to lay Brent off, say, Brent, we love you. We want to hire you back. We're going to have to lay you off for a little bit. But the goal is to hire Brent back at some point. Generally doesn't happen because Brent goes and gets a job somewhere else. But theoretically, that's what a layoff is. I'm just laying you off for the moment. I'm going to hire you back. That's what a layoff is. Versus, Brent, don't need you. Go away. That's a termination. Layoffs become terminations. Brent, we're going to lay you off for 2 weeks. We're going to hire you back in a couple of weeks as soon as things kind of smooth out. 2 weeks later, Brent, don't need you. Right? Layoffs become terminations. But we're seeing these starting to really ramp up. Netflix, TikTok, Snapchat, all these companies now laying off workers. Those haven't shown up in the employment reports yet, but those are coming. Particularly if that pace of layoffs continue to tick up. We'll see. But see, those are the things that are going to come back and impact earnings. And there's that risk going into the next quarter earnings that we could see still weak earnings growth because of what's happening in the economy. So again, don't dismiss the economic data. It's important because it feeds through to the earnings data, which eventually affects the price of the market. All right, wraps up the show for today. Get by the website. Our weekly market recap with Adam Taggart on the website, realinvestmentadvice.com. Get our newsletter, the Bull Bear Report. That's out, talking about this battle royale between bulls and the bears. We lay out both cases for you. And then also, of course, our daily market commentary. That's out this morning as well. All at the website, realinvestmentadvice.com. See you back here tomorrow.
It's a rich man's world.